Welcome to the Deep Dive. This is where we take a whole stack of information and, well, try to make it crystal clear for you. So today we're tackling something that, feels almost like common sense.
Right.
When the Federal Reserve lowers interest rates, are home prices just guaranteed to soar? Is it really that simple?
It's definitely the story you hear all the time, isn't it? That narrative is really strong.
Yeah.
Fed cuts rates, mortgages get cheaper, everyone buys, prices just shoot up. But when we dug into the data, almost 25 years worth from 2000 right up to April 2025, well, the reality is just a lot more complicated than that.
Exactly. So our mission today is to kind of cut through that simple story and give you a more, let's say, nuanced, data-driven view of what actually goes on. We've been digging into the Inflation-Adjusted Home Price Index, HPI.
Relative to CPI, the Consumer Price Index.
Right, and alongside those Freddie Mac mortgage rates, the primary mortgage market survey data.
And it's really key that we look at the inflation-adjusted HPI compared to CPI, not just raw home prices.
Why is that so important?
Well, because raw prices can be pretty misleading, Inflation eats away at value.
Okay.
Adjusting for it and then comparing it to how all consumer prices are changing, that gives us the real picture, how much house your dollar actually buys.
Gotcha. So it's about true affordability and market health over time.
Exactly. So what you'll get from this deep dive is hopefully a much clearer perspective how Fed policy, mortgage rates, home prices, how they really connect.
Moving beyond just the easy assumptions.
Right, getting into the bigger economic forces actually driving things.
Okay, so let's unpack this. Let's use some real examples from the data. Where should we start? Maybe right at the beginning of our timeline?
Yeah, let's look at the period right after the dot-com bubble burst and 9/11. Early 2000s.
Okay, so conventional wisdom, the story we talked about.
Yeah.
It would say the Fed slashed the federal funds rate really aggressively back then.
Oh, they did. From 6.5% in 2000 way down to 1.25% by late 2002. A huge drop.
So you'd think home prices would just explode, right? What did the data actually show then?
Well, yeah, intuitively you'd expect this massive surge. And mortgage rates did fall, along with the Fed rate, from about 7.38% down to 6.05%.
Okay.
But what that period really shows is, well, yes, the inflation-adjusted HPI-CPI did go up. It rose about 12.31%.
Yeah.
But it was steady, gradual. It wasn't this sudden, dramatic boom.
Interesting.
It definitely helped the market, made borrowing cheaper, sure, but it didn't just light a fire under prices. So it kind of sets the stage right away for a more nuanced picture. Lower rates, they can help, create a good environment.
But they don't automatically mean boom times.
Exactly. Not guaranteed.
Okay, that's a really critical distinction right from the start. It makes you rethink that simple cause and effect. But if we want a real test of how complex this market is, we absolutely have to talk about the 2008 financial crisis.
Oh, absolutely.
That period, maybe more than any other, just completely challenges that simple idea about rate cuts boosting prices.
Yeah.
What happened then?
Right. So, in response to that crisis, the Fed, well, they did things nobody had seen before. They cut the federal funds rate practically to zero.
Okay, near zero.
But, and this is crucial, they did more. For the first time in December 2008, they started buying up huge amounts of mortgage-backed securities, MBS.
Okay, hold on. MBS, mortgage-backed securities. Can you quickly break that down? What does that actually mean for the housing market? How did that work?
Sure. Think of it like the Fed going directly into the market and buying up bundles of existing mortgage loans from banks.
Okay.
This floods the banks with cash, right? Which makes them more willing to lend out money for new mortgages.
Oh, okay.
And critically, it pushes down the interest rates on those new mortgages. Way more, potentially, than just cutting the main Fed rate could do on its own.
So it was a much more direct hit on mortgage rates.
Exactly. A very direct intervention. When they started this, the inflation-adjusted HPI-CPI was at 0.7267, and mortgage rates were already down around 5.29%.
So the Fed pulls out all the stops. They're buying MBS, pushing mortgage rates down even further. They eventually hit, 3.89% by February 2012?
That's right. Rock bottom rates.
You'd think, okay, now the housing market has to rebound instantly. Fed intervention, super cheap money.
You'd absolutely think so. But what happened next really does challenge everything you might assume about these kinds of interventions.
What was it?
Despite those rock bottom rates, despite the Fed buying up MBS like crazy, home prices kept falling for over 3 years after the intervention started.
Wow, 3 years.
Yeah. Remember, prices peaked back in March 2006 when the HPI-CPI was 0.9232. From that peak, they crashed. A staggering 35.23% drop down to the bottom in February 2012.
35%.
And even if you just look at the period after the Fed started buying MBS in late 2008, prices still fell another 17.72% over the next 38 months.
Unbelievable.
So this period just makes it incredibly clear.
Yeah.
Low interest rates alone, even supercharged low rates, they just can't fix everything.
They can't override those deeper problems.
Exactly. Things like massive unemployment, huge numbers of foreclosures, just fundamentally weak demand across the board.
Okay, wow. So record low rates, direct Fed help, and prices still tanked. For someone like me, who kind of defaults to low rates equal boom, what was the missing piece? How do those bigger economic problems overpower cheap mortgages?
It really boils down to fundamental supply and demand.
Okay.
If unemployment is sky high, fewer people can actually afford to buy a house, right? Even if the mortgage payment looks cheap on paper.
Right. You need the income, the job security.
Exactly. That crushes demand. And then, at the same time, you had all these foreclosures hitting the market.
Flooding it with supply.
Precisely. Distressed properties coming up for sale everywhere, so you've got really low demand meeting really high supply.
Prices have nowhere to go but down.
Exactly. It doesn't matter how cheap money is to borrow in that scenario. The interest rate is just one part of a much bigger economic picture.
That really, really drives the point home. Okay, so after hitting that devastating bottom in February 2012, was the recovery quick? I mean, rates were still super low.
No, not quick at all. What followed was a slow, pretty methodical recovery.
Right.
By December 2013, so almost 2 years later, the HPI-CPI had climbed back about 14.74% from that low point. It reached 0.6859.
And rates during that time?
Still historically low. They bounced around a bit between maybe 3.35% and 4.46%.
Till incredibly cheap borrowing.
Absolutely. But even with those great rates, it took years, literally years, for the market to get back anywhere near its pre-crisis peak.
So the recovery path was gradual.
Very gradual. It just reinforces the idea. Low rates can help set the stage, create favorable conditions maybe.
But they don't automatically flip a switch for prices to surge.
Exactly. No sudden jumps.
You know, looking back at those two periods you described, the early 2000s with gradual growth after rate cuts, and then 2008-2012 where massive cuts and interventions didn't stop the bleeding. It makes me wonder, were the Fed's actions fundamentally different? And did that difference explain why prices reacted so differently? What's the real distinction between just cutting the federal funds rate versus buying up MBS?
That's a really crucial question, and comparing those periods highlights the difference perfectly.
Okay.
So 2001 to 2003, the Fed mainly used its traditional tool, cutting the federal funds rate, a lot.
Right.
And mortgage rates followed. They dropped from around 7.07% down to 5.88%.
Fed prices.
Inflation-adjusted prices went up moderately, about 15.13% over that window. So a clear link, but a measured response in prices. That was mostly a federal funds rate story.
Okay. Standard Fed playbook, moderate price increase. Got it. But then 2008 to 2012, different story.
Total different playbook. In that 2008-2012 stretch, the Fed used both near-zero rates and those unprecedented MBS purchases.
The direct intervention.
Yes, much more direct in the mortgage market itself. And mortgage rates fell sharply, even more than in the early 2000s.
But prices still fell for years.
Yeah, right. They fell for years before finally stabilizing. It just hammers home the point that, yes, borrowing costs matter. A lot.
Sure.
But these other things, job security, how confident people feel, the actual number of homes for sale, foreclosure rates, they play just as big a role, maybe even bigger sometimes.
It's not just the price tag on the loan.
No, it's about whether people can actually borrow and whether they want to buy, given everything else going on.
Right. Confidence, opportunity, basic supply.
Okay, so let's fast forward a bit. What about more recently? We've seen some pretty big shifts since, say, 2022. What's the data showing us there up to April 2025?
Yeah, things have definitely been dynamic. So the inflation-adjusted HPI-CPI actually hit its recent peak back in May 2022. It was 1.0412. Mortgage rates then were around 5.23%.
Boutique prices, rates around 5%.
Then the Fed started hiking rates aggressively, right, to fight inflation.
Right, big hikes.
And mortgage rates shot up. They hit 7.62% by October 2023.
Ouch. And home prices?
Predictably, they responded. The HPI-CPI dipped. It fell 2.21% from that May 2022 peak. Okay, so higher rates did cool prices off a bit, as you'd expect.
Exactly. But then, interestingly, by April 2025, the source data shows mortgage rates had eased back a little to 6.73%.
Still high compared to the crisis lows, but down from the peak.
Right. And home prices had actually stabilized by then, even started a modest recovery, with the HPI CPI back up slightly to a 1.0237.